Well, hello, everybody. It's John Strebler, editor of JSIO, John Strebler's Investment Outlook, coming to you Monday morning from Northwestern Washington. I want to start off by reminding, if you're not a subscriber, I offer a free trial for 4 weeks. You get 4 issues of my weekly newsletter, generally 6 to 9 pages, lots of charts, analysis, and recommendations. Comes to your email box every Sunday. It's totally free. You don't have to put down a credit card or anything. All you have to do is send an email to me saying, hey, I'd like to try that free trial. Send it to the email address at the bottom, jstrebler52@gmail.com. I'll put that up again later, but that's the deal. If you decide later that you like the newsletter, you can subscribe for $325 a year. It's going to get you 50 issues at least, 50 to 52 issues like the ones that you're going to see as a sample. So with that in mind, today, instead of taking a look at my entire newsletter, I'm going to just focus on a couple of things that are on my mind, a couple of things that I think are important. And they're both having to do with the stock market. So let's go back and take a look at what's going on with the stock market as shown by the Dow Jones Industrial Average. And I'm going to do that via point and figure chart here. New highs across the board in most of the averages and so forth, except for the Dow. The Dow hasn't been able to get above 45,000. We see this big resistance area here, and it started back in November last year, got about 45,000 installed, prices dipped, got back up to 45,000, couldn't do anything, got up a third time, couldn't do anything, and then the stock market crashed. Well, the last few months, stocks have worked their way back up again to guess where, about 45,000 on the Dow, where it stalled out, came down, tried again, 45,000, stalled, boom. And so this is a huge area of resistance for whatever reason. Whenever the Dow gets up to around 45,000, people start selling, and they won't let it get any higher. Well, at some point, I think you're going to exhaust all of that selling. At some point, the Dow is going to break above that 45,000, and the theory is once it does, and it's going to have a big move on the upside. That's the idea of breaking through resistance. And if the Dow has a big move on the upside, I think it's going to drag the rest of the market with it. So one of the things I'm considering is whether or not to increase the recommended amount of stocks that we hold. Currently we're at 30%, thinking about going up to 35%. And probably the biggest thing that's going to make me pull the trigger on that is if the Dow can break above that 45,000 convincingly. We'll come back and take a look at that. But before we do, I want to talk some more about the AI situation. We had the .com bubble back in the 1990s, and internet stocks just soared because the internet was being, was new, and it was affecting the economy, and everybody was buying technology shares and so forth. And then it crashed. We had a big decline, 80%. Well, people are worried that what's going on with AI right now, if it's going to be another bubble or not. Let's take another look at it from what we did last week. And here what I did was, on the left you can see, I looked at, I'm showing 6 years worth of history for the stock market starting in 1994. 6 years showing what happened to the NASDAQ, to the Standard & Poor's 500, and the Dow Jones Industrial Average. Well, during the .com era, most of the technology stocks were concentrated in the NASDAQ index, okay? And so that's the one that went up the most. And you can see it just soared to a, ridiculous price. Standard & Poor's 500, those 500 stocks didn't do nearly as well. They only rose about half as much. And then the Dow Jones Industrial Average, blue chips, they were up even less, maybe half of what the S&P did. So it was really a fairly thin market advance, meaning that, it was relatively few stocks that were soaring, and the rest of the stock market really didn't do that much. Well, let's take a look now at the current picture. So here's the last 6 years, currently starting around 2019, and the AI boom led by artificial intelligence and all the ways that it's going to make our lives more productive and efficient in ways that we can't even dream of, they're telling us. Well, guess what? The NASDAQ with its technology shares, it's done the best. It's up that much. But the Standard & Poor's 500, it's not that far behind. That's where it was as of Friday. Okay, up almost as much as the NASDAQ. And the Dow Jones Industrial Average, not up as much as the other two, but up about twice as much as it was during the .com era. What this all tells me is that, especially compared to the .com era, we have a much broader market advance. There are more stocks going up than going down, and the upward progress is not just concentrated in a few shares. The entire stock market is going up, and that's usually something that is more sustainable. If you have a market with good breadth, positive breadth, like we've been seeing now, it's less likely to experience a crash, a popping of the bubble like we saw, some 25 years ago. So that makes me a little more optimistic, even though the prices of these technology shares and the market as a whole, even though they're pretty high and the market's overbought, it makes me more willing to step in. And so once again, I'm pondering, let's put it up here. Once again, I'm pondering whether to raise our recommended holdings to 35%. We'll see, but it's going to mostly depend on what happens with the Dow Industrial Average. If we do get a breakout, and I recommend it should go up to 35%. We're going to do that in 3 different areas, the 3 areas that I want to concentrate in. Well, first of all, one of them is DIA. That's the Dow Jones Industrial Average itself. This is an ETF you can buy that copies the Dow Jones Industrial Average. XLK, been recommending that for years. This is a technology ETF. It's been doing very well, and of course I would expect to continue to do well. And then also a reminder that, we want to be invested in stocks outside of the U.S. VEU is an ETF I've recommended for years to invest in non-U.S. shares. So stay tuned. We'll see if, I actually pull the trigger on that one or not. Let's do that. But once again, I'm going to leave it with this. Here's the email address if you decide you want the free trial there. Send me an email to jstrebler52@gmail.com. Otherwise, if you enjoyed the video, put a like on YouTube and leave a comment. If you do those things, that tells me that the videos are appreciated, and I'll keep doing them. And if nobody does it, then I'm going to, not put in the effort. But let's keep fingers crossed, and hope to see you next week with another video. Okay, take care.